Take a look at the Treasury market this morning. You could see yields are up, but they are well off the highs that we had seen earlier in the week and last week. The 10-year right now yielding 4.44, the 30-year's at 4.93, and the 2-year is at 3.95. It is a bit of a relief rally for bonds yesterday after the president postponed tariffs on the Eurozone. Rising bond yields, though, in Japan could spill over and impact the U.S. market, and that's been something we've been paying attention to since last week as well. For some insights on this, we want to bring in Lindsay Rosner, the head of multi-sector fixed income investing at Goldman Sachs Asset Management. Lindsay, there's so many weird things that are happening in the bond market right now. Demand on 20-year auctions really weak, both in Japan and here last week. What's happening? Where is this all kind of falling out?
Sure. Well, we say it's not really that important to focus on the 20-year. It's kind of like the ugly stepchild of the Treasury curve. So I wouldn't say that that's the greatest indicator, but certainly what happens in the 30-year, what just happened in the 40-year auction for Japan, that is important, to your point, and it's been a little bit weird. What's going on is really price discovery. There are questions across the board of what fiscal looks like across the globe. And the resounding answer from the market right now is there should be more term premium, i.e. higher yields in the back end. Yeah, not just a U.S. thing, not just a Japan thing. It's
a global concern about fiscal responsibility, but I think it's also happening at a time where the central banks are trying to step back from being the largest purchasers in these markets. Japan's trying to do that, so's the U.S. I mean, this is still the unwind from the great financial crisis.
That's true. And I think what was interesting, we did start to get a rally in the back end. And to your point, the weirdness is we're having this back and forth frenetic motion in the back end of the curve, and it's hard to figure out where are we going to actually settle down. And there actually was a survey put out in Japan to say, what do you think the right issuance pattern is?
Right.
And that survey gave some hope that maybe there'd be less issuance in the back end, which would lead to some relief and yields could be lower. And I think until we get more certainty and clarity there, we're going to see this kind of frenetic behavior.
So what's a bond investor or a potential bond investor to do at this point? Do you look at any of these government-issued bonds? Do you say, OK, as a result, here's what we're going to do with corporates?
Yeah, well, first, we do something in the duration space, and second, we do something in corporates. In the duration space, I think it's really important to remember that there's a full curve that you can invest in, and the parts of the curve behave differently. The back end of all the curves are really responding to fiscal. What would be most sensitive to central bank policy would be the front end of the curve. So we actually like duration in the front end, call it 5 years and in. So all this movement in the back end, we think not that you can ignore it, but in terms of portfolio construction, don't be exposed to it. Stay in the middle of the curve. And then elsewhere, and yes, it's all related to what happens in rates. I like to think of like the fixed income market's like a house where the foundation is actually the rates market and the levels above it are the corporates, the structured product, et cetera, exciting home. It's that stuff that we actually find is interesting, still affords a lot of spread, but you have to do your homework because those kind of things, like corporate bonds, for example, can be in the crosshairs of tariffs. Which is funny. We've been so focused on fiscal in the past 2 weeks. There's been less discussion outside the EU tariff thing about broad tariffs, but they're still around and they still matter.
And matter how to corporates? Like how do you factor that in and what's safe and what's not?
Yeah, it's what will have sensitivity to tariffs. So think about input costs or where a company sells products. That all is going to matter. So we're trying to stay away from the areas that are really sensitive, like retail, for example, like autos, depending on where they're produced, and finding places that have less sensitivity to tariffs. So tariffs are super important, and that's why we have a ton of research analysts that help us do that.
I was surprised that that point you made in the notes, just the idea that, look, bonds have still outperformed stocks this year, even though we've seen some pretty massive rebounds over the last month.
Yeah, there not to say that yields haven't moved higher or they haven't moved a lot this year in both directions. I mean, the daily delivered vol of rates has been extremely high. But we need to take a step back and remember, stocks are up as of this morning, I think 0.7% on the S&P. The ag, which is just a basic proxy for public fixed income, is up 2%. Like, you're still winning, actually, in bonds. And if you want even more yield, snore? No,
yeah.
no.
Unless you got a lot of money and you're an insurance company, there's no reason to ever, or you're 100, there's no reason. I think you need to shift your focus to crypto. say at Goldman, say I no longer want to cover. It's just.
You know what? Where
for,
we
for
may
big
find
money and safe
some
money,
common
you
ground.
need. Okay.
Okay, I'm going to try here, Joe. I think where we could find some common ground is a diversified portfolio. Maybe you could have a little bit of crypto,
have some
bonds, some stocks,
to try to minimize volatility.
Portfolio.
But did you hear what you did? You said stocks are only up 0.7, and bonds are up 2%. I mean, think about what you're saying.
Right.
Well, that's not even a big move on a daily basis for a stock. I mean, I'd rather take my chances in, I don't know, dividend yielding stocks. Look, for insurance companies, and there are people that are suitable for fixed income. There's no doubt about it. But
yeah, I think you're on a glide path your whole life, right? You're supposed to start off, remember the rule, I don't know what it is, 60 minus your age. Right. How much you're supposed to be in stocks, and over time you're supposed to transition into
supposedly.
bonds.
How about maybe tax-free?
But there is often a correlation between risk assets and bonds,
definitely.
And bonds can protect you.
I definitely think you can use it also to make determinations about what to do in other asset classes, what's happening in the bond market.
It's informative.
Right. But a pure 5-year note to put any money in that, I mean, you probably have a nightlight, too, and sleep with the lights on.
But it goes back to, like, do you have homeowners insurance?
No, nothing's going to happen.
Nothing's insured with you. You're just riding.
You say have a mortgage with that.
No, I don't think anything's going to happen. We're very careful. No, yeah, of course I have homeowners.
Okay, so you get bonds. It's the same
Life
kind of thing.
insurance, too.
Same kind of thing.
Life insurance, I definitely don't like. Because I never want that to pay off, obviously.
Right, that's the hope, right? But you have it for that kind of rainy day or problem.
Got to have second to die.
Look, Joe, if you had a recession, what's going to do better, stocks or bonds? And this year we've been debating what's the probability of a recession.
I hear you, and I know this is your chosen profession and everything.
This is our moment, too.
And this is
bonds are cool. Give me some limelight. Help.
You know what's cool? 13.5 triple A tax freeze back in the day.
Okay.
That is exciting. Think of that.
Okay.
That was like early 80s? What are we talking about?
That was early 80s.
Early 80s.
I may have been in utero, but I will take your word for it.